What's up, guys? Right now, the market is doing what it always does during uncertain times. Prices pull back, sentiment weakens, and short term investors become more cautious. But when you look underneath the surface, the picture is not always as negative as the prices suggest. In some cases, the business is still growing, demand is still there, and the long term thesis remains intact. That is where long term investors start paying attention. In this video, I'm going through four stocks that have either pulled back or are still trading below what many investors believe their long term potential could justify. The key is not that the price moved lower, the key question is whether the underlying business is still strong enough to make that pullback matter. Let's begin with the first company. The first stock we're looking at is Advanced Micro Devices, or AMD. AMD is one of the most important semiconductor companies in the market, especially because of its exposure to data centers, high performance computing, and artificial intelligence. The company reported a fourth quarter 2025 revenue of $10.3 billion, which was a record, with the net income of $1.5 billion and a diluted earnings per share of 92 cents. On a non-GAAP basis, net income reached a record of $2.5 billion, and AMD's data center segment grew to $5.4 billion in quarterly revenue. Okay, with that said, the AMD story in March 2026 is not simply a straight bullish line. The company guided that it would make a revenue of $9.8 billion in the first quarter of 2026, which implies a sequential decline from the fourth quarter. So, Reuters noted that this softer near term outlook raised concerns about how hard it is for AMD to still take a share in the AI accelerator business against NVIDIA, especially while large customers continue investing in custom chips. So the AMD thesis today is not that there are no risks. The thesis is that AMD is still executing well, data centers demand is still expanding, and the pullback reflects the tougher expectations and competition more than that AMD will collapse as a business itself. What makes AMD interesting here is that it still has multiple engines of growth. It has CPUs, it has GPUs, and it has AI inference and training exposure. And it has a growing data center business that is already generating billions in quarterly revenue. The market has become selective and investors are no longer willing to pay any price for AI exposure. That is exactly why AMD becomes worth watching on weakness. The business is still growing, but the valuation is no longer being treated as if everything must go perfectly. That is usually where better risk reward begins. The second stock is Boeing, ticker BA. Boeing is a very different kind of idea. This is not a pure growth story, it is a recovery and execution story. Boeing reported a fourth quarter 2025 revenue of $23.9 billion, with operating cash flow of $1.3 billion and a free cash flow of $400 million. The company also said that the total backlog rose to a record above $500 billion. Now, one very important correction needs to be made here. It would be misleading to present Boeing's latest profits as if it came entirely from its core business improving. The company's GAAP earnings per share of 10.23 and core EPS of 9.92 were primarily helped by a $9.6 billion gain on the sale of its digital aviation solution business. So, yes, the quarter looked dramatically better on the surface, but investors should understand that this was heavily influenced by a one time transaction. Even so, there are real reasons investors are still watching Boeing closely. Reuters reported this month that Boeing expects to raise 737 MAX production from roughly 42 planes a month to 47 sometime around mid 2026. And management has said the company expects a positive free cash flow of $1 to $3 billion in 2026.
When you look at free cash flow, you had two quarters in a row, third and fourth quarter, with positive free cash flow, but negative for the year. What are you expecting for 26? Can you put a parameter out there that people can say, okay, that's what you're expecting? Yeah, we're expecting low single digit billions in positive cash flow. Like 1 to 3 billion. Yeah, 1 to 3 billion in that range for this year, and that'll continue to grow as we ramp up production and deal with some of these headwinds that we have to cash flow in the near term. So we're marching to this $10 billion free cash flow number, and it's going to take us a little bit of time, but we've got a methodical plan to get there.
So that is a much more realistic and up-to-date figure than the older claim that Boeing would generate more than $10 billion in free cash flow over the next 2 years. The real investment case here is that Boeing is gradually improving operations, increasing deliveries, and trying to rebuild its confidence after years of crisis. So with Boeing, the thesis is not that the turnaround is complete, it is that the company still has an enormous backlog, commercial aerospace demand remains strong, and even modest operational improvements can have a meaningful effect on cash flow and sentiment. This is a stock for investors who believe execution will keep getting better from here, not for investors who need everything to already look perfect today. The third stock is Vistra, ticker VST. Vistra has become one of the most interesting utility names in the market because it sits at the intersection of electricity demand growth, data center expansion, and nuclear generation. The broader thesis is simple. AI does not just require chips, it requires power and a lot of it. Reuters reported in February 26 that US power consumption is expected to rise sharply this year and next, driven in part by the AI and crypto data centers as well as broader electrification trends. Vistra reported a full year 2025 net income of $944 million. The company also reaffirmed its capital allocation framework and its long-term generation and infrastructure plans. In late 2025, Reuters reported that Vistra had signed a 20-year nuclear supply deal for 1,200 megawatts, and it also acquired 7 natural gas plants totaling 2,600 megawatts. Earlier, Reuters also reported that the company planned to add more than 600 megawatts of nuclear generation by mid 2030 to meet rising electricity demands. This is why Vistra is no longer viewed by many investors as a just slow-moving utility. It has baseload generation, nuclear exposure, acquisition that expand capacity, and the direct relevance to one of the biggest themes in the market, which is whether the grid can support the next wave of AI infrastructure. The stock is also well below some of the levels it traded during its highest and strongest momentum phase, with shares being currently at about $152. The investment case for Vistra is that rising power demand may not be a short-term story. If data centers demand continues increasing and reliable power becomes more valuable, then companies with generation assets, especially nuclear and dispatchable power, could be in a much stronger position than the market is used to assume. Vistra is not the cheapest stock in the market and it's no longer undiscovered, but it still has a very clear thematic tailwind. Okay, on to the fourth and final stock, Alibaba, ticker BABA. Alibaba is probably the most controversial name on the list, but it's also very important to update it properly because the recent numbers were not as clean as the older bullish summaries made them sound. Alibaba reported its December 2025 quarter on March 19, 2026. Revenue rose only 1.7% year over year to 284.84 billion yuan, which missed analyst expectations, and net income fell 66.3% as spending increased in food delivery, promotions, and rapid delivery competition. After the report, the US listed shares fell more than 6%. So if someone presents Alibaba today as a simply cheap growth stock with everything moving in the right direction, that's incomplete. The reality is more mixed. The core e-commerce environment remains very competitive and consumer sentiment in China is still soft. But the reason Alibaba remains interesting is that its cloud business grew 36% in the quarter, driven by AI related demand, and management has said it's still targeting more than $100 billion in combined cloud and AI revenue over the next 5 years. The company also previously committed to investing about 380 billion yen or roughly $53 billion over the 3 years to build out cloud and AI infrastructure. In other words, right now, Alibaba is not a clean consumer comeback story. It is a combination of a pressured commerce business and a rapidly growing cloud and AI segment. That split matters because investors who like the stock are essentially betting that the market is overly focused on the near term weakness in the commerce side and not fully valuing the long term optionality in AI, cloud, and enterprise technology. So when you put all four names together, you get four very different setups. AMD is an AI and data center semiconductor story with real growth, but also real competition. Boeing is a recovery story where investors are watching the production, deliveries, and cash flow more than the headline earnings. Vistra is an electricity and infrastructure play tied to the rising power demand for AI and data centers. And Alibaba is a higher risk value and AI transition story where cloud growth is strong, but the legacy commerce business is still under pressure. The common thread is that each stock has a reason to be debated. None of these are perfect, and that actually matters. Good investment opportunities usually do not appear when the story is easy and universally loved. They appear when there's still uncertainty, but enough underlying strength for long term thesis to stay alive. So, as always, this is not financial advice. This is simply my analysis based on the most recent available information. If this breakdown was useful, thank you for watching, and I will be seeing you guys in the next video. If you guys want to comment something or talk about some stocks, please comment below. We can talk about it. Subscribe on the channel, and see you guys in the next video.